Nitin Rahija joins us, Chief Investment Officer with AQF Advisors. Nitin, good morning. Good to have you back on ET now. Nitin, sketch the big picture for us. It's looking outright ugly. Everything is on a butcher block. Things are falling as if there is no tomorrow.
So absolutely. I think the previous so-called safe havens, like if you take BFSI, I think that has caused ultimate pain, in the last, 1.5 months as concerns on NPAs. And, the fact that interest rates, at least in the short term, seem to be, on the higher side, have all added concerns. And that, this is almost like 30-35% of the segment of the market. So previously you had a situation where the markets were trading in a range, but you had these few sectors. You had the FMCG, the pharma, the BFSI sector holding up. So essentially what is really happening in the market is that the market is portraying that, if you look at the market, it's maybe 10% off its all-time highs. But what you're seeing, the situation on the ground is there seems to be a lot of pain at this point of time. There are, the sectoral the rotation has now gone to an IT, pharma has remained where it is, and you have FMCG. But take that out and you see tremendous amounts of pain. I think, you're seeing a market which is really dichotomous. At one hand, you're seeing some stocks which are at all-time highs, and there's most of the other stocks are at probably index levels close to, half of these, and so on and so forth. So I think the weak macros are, having big impact on micros also, and, I think there is consensus bearishness that seems to be creeping into the market. So, you have to look for those islands of prosperity to sustain yourself. But let me tell you, it is becoming tougher because the volatility, the slight disappointment in any of the stocks is seeing sharp reactions. So at a portfolio level, it's becoming more and more difficult to, generate returns at this point of time.
Nitin, hi, morning. What did you make of SBI's earnings? Because it's pretty alarming the way the NPAs have panned out for the entire PSU lot.
Yeah, I think it was expected. If you really look at the type valuations that had started building up into these, most of these banks have already been quoting below book and so on and so forth. So yes, in the sense it was NPAs has been a concern as far as PSU banks is concerned. But I think the SBI NPA number that came out was a little more alarming than what came out. But I don't think it is something out of the blue.
But then, according to the UBS report, ONGC valuations are at a 5-year low, and according to JP Morgan, State Bank of India valuations are at a 10-year low, whereas valuations for HUL and ITC are at an all-time high. So it's a very divided market. One end of the market is sitting at an all-time high, one end of the market is sitting at a historic low. So what should one buy into? Chase quality, stay with quality, or now it is time to really start treasure hunting in the value or in the beaten down end of the market?
I think when you talk about treasure hunting in terms of the beaten down part of the market, one could do that, but look, one has to be ready that it's going to be an extremely long haul. Because, what would be the value drivers? I think it would be mostly running on hope at this point of time, from a perspective that you would hope that the election results come and things start improving, and so on and so forth. Or, you suddenly see the macro situation, as the finance minister is saying that the current account deficit will be kept at 3.7, fiscal deficit will be kept. Hopefully that, gets the sentiment going. So, right now I think it is a little early in the day to play the contrarian, value hunting call, because I think the next 6-8 months could see the pain accelerate much more than where it is today. So if you take the banking stocks, you could probably see, if this situation continues, I think the pain with corporate sector will increase, and so the NPA problem will get a little more pronounced, and so on and so forth. So I think playing that deep value call today is a little early. Right now I think people would prefer to stick to the safety of quality names where there is some sort of visibility as far as business is concerned.
Nitin, what have you made of the move witnessed by the entire metals pack? Does it seem like this is just a technical aberration or one-off move, or do you think there is some bottom fishing which is taking place because metals were so beaten down?
Well, it's a mix of both, really. I think, you will have some contrarian investors looking at value and taking this thing, but I think it is really too early to play into that metal pack, because I don't think if you see that most expectations in terms of the GDP number this year being at an all-time low, demand for metals, at least from an India perspective, will remain poor. Of course, there is some expectation that if there is a global recovery that is showing initial signs, UK has shown some green shoots, the US is doing much better. There could be, some uptick, but I think it's given the kind of debt that most of these people are sitting on, also given the fact that a lot of the projects are facing raw material constraints due to environmental reasons, I would be a little wary of playing that pack.
Nitin, what is your take on metals? The fact that China is slowing down and the demand for base metals will remain weak, it's out in the open. Everyone is aware about the pain in the commodity cycle and the fact that the super cycle in commodity is over. But how much of the bad news is already in the price? A stock like Tata Steel is trading at a 50% discount to its book value. A stock like Hindalco is now trading at a 40% discount to its book value.
Yeah, so sure, I think in my view, if you really look at it, a lot of the pain is manifest there. The fact that if you will see that even if you compare the kind of debt that is, what is happening is when you're looking at book value, Nikunj, you say 40% discount to book value, 50%. But there's a lot of debt which is sitting on the balance sheet of these companies. So essentially, when you add up the enterprise value and look at it, they're getting to a stage where, the cycle is slowing. And this is the point of time where their concerns on the debt seem to will start weighing in, and that's taking away a lot of even the profits of the low-cost producers and so on. So I think if you ask me, a lot of concerns are already in. Are these stocks cheap? I'll say at this point of time, given the lack of visibility and the kind of pricing that exists for metals, they're probably, I would not want to get into them even at these levels.
Nitin, if the entire IT space per se is in some kind of a bull run, why is all the action in the IT sector really getting concentrated in 4 or 5 stocks? If I look at mid-cap IT stocks, KPIT, Mindtree, Geometric, Hexaware, they've hardly participated.
Well, not exactly, Nikunj. I mean, if you take a stock like Hexaware, it was at, trading at 78, 80 levels on the back of the disappointment of the results about 6 months ago, loss of a customer. But as things have stabilized, the stock is at 122, so it has given very handsome returns. But that's one stock. If you really see the other mid-cap stocks, they're probably just holding themselves or are marginally up. The kind of return that they've given is not really more. I think people are again chasing the safety of the large cap names and the quality that exists. And obviously, these guys have demonstrated results which are far superior. So when you look at the HCL Tech result, you look at the TCS result, you'll see their results have been far, far superior at this point of time. And when you compare some of the other names, say Persistent result was a disappointment vis-a-vis expectation. Hexaware I already talked about. So I think the mid-caps have not yet come and demonstrated consistency in their numbers vis-a-vis the large cap, and that's probably the reason why at this point of time, where there's so much of concern on the downside, people are really sticking to the larger cap names and the quality names. But I think there exists an opportunity. I think stocks like KPIT and so on and so forth are very, very well look very attractive at these valuations, and one could actually look at getting into some of these.
Nitin, how would you approach the FMCG pack? Because after a fair amount of run-up, last week we saw some easing out when it came to names like Unilever or for that matter ITC, and yesterday again they were back into action.
Yeah, I think it's really a simple question of the TINA factor, as you call it. The people are sticking to FMCG because a lot of them are also looking at FMCG as a parking place for cash at this point of time because, of the lack of alternatives as such. So FMCG has always been that in such markets which are more defensive oriented. People are really trying to see how they can conserve their capital at this point of time, and hence, you're seeing the premium as far as FMCG valuation, going up even further. If you ask me honestly, all these stocks are priced to perfection, where the slight disappointment also can, cause drastic cuts. But that's the way the market is looking at it right now.
Rupee is now less than 30 paisa away from a historic low. And Nitin, this is not good news.
Yeah, I think, Nikun, all these measures that have been taken will take the time to start showing up. Right now, I think the rupee is really fighting a credibility issue, which so is the government, because, there have been so many reassurances in the past, and unfortunately, they've all fallen flat. So I think I will probably, all these measures that have been taken as far as the trade deficit is concerned, measures to bring in FDI, they will start slowly, showing up, and and the impact is more long term the way I see it is. So I think sentimentally the sentiment is yet one of skepticism, and that's what's keeping the rupee here probably. But I would believe that a lot of what has happened in the rupee is probably done, at least in the shorter term. And once these measures start seeing inflows, you will see the rupee. I don't see too much of a strength happening, but I think the rupee should start stabilizing.
Do you think private banks have lost that status of being called as safe haven? Just about every fund manager, every portfolio manager was hiding into private banks. Do you think that crowded trade is now reversing and it could reverse further?
I think the crowded trade is reversing, no question about it. And I think the fears on the fact that the NPA levels could probably, which these banks had so far managed very well and seemingly got insulated. We started seeing first signs in this quarter results where, you saw their NPA level moving up. So despite which the kind of growth that they showed, really took care of that. But I think the kind of correction that we've seen is also, if you really look at these banks, ICICI has always had an issue in terms of the growth of ICICI. It's been slowly coming back. So valuations of ICICI is not was something that one can crib about. It is quite attractively priced. But if you take Yes Bank and IndusInd Bank, they were all trading at 3 times book, plus. And so hence, when you've seen these cuts, you've seen the sharpest cuts take place in these 2 banks. My own view is, Yes Bank also has this overhang of the promoter issue that is weighing in on it. My own view is that I think while it's too early to call, I think somewhere this correction has been done, and these banks, I believe, based on the kind of growth that they're seeing, based on the business plans, especially IndusInd Bank looks interesting at these levels. You cannot rule out that there might be some more pain, but I think one can start looking at getting into these banks, because I think the fact that they've managed so well, despite the kind of pain the economy has seen, I think there's a reasonable confidence that this bank will come back. ICICI, I think, looks attractive. I think this trade of risk aversion as far as NPAs might continue for some time, but I think by and large, I think this sector looks good. Once this initial risk aversion or fear subsides.